So with me today, I have Harry Colvin, senior economist at Longview Economics. Harry's going to give us a brief description of the status of the US economy and the outlook for bonds. Please, Harry.
Great, thanks, Stefan. Well, look, I think there are two key themes that are going to be dominating US bonds and indeed the interest rate market in the US over coming months. And both those themes favour being long bonds. They favour looking for lower yields. And they include, firstly, some evidence that things are starting to break in the US economy and in the financial system as a result of tight money. And then I'd say that the second is linked to that, growing evidence that underlying inflationary pressures have peaked and are now falling. And if we think about what causes a recession, if you look through history, it's three things. It's tight money, it's evidence of a shock, whether that's an oil price spike or a bursting of a bubble or a pandemic or whatever it is. And then it's a corporate sector that is retrenching and cutting costs and tightening its belt. So, it's those three things, or at least one or more of those things, a combination of those three things. That's what we see just before recessions. That's the heart of the recession dynamic, which is the cost cutting caused by tight money and caused by a shock. And I think we've got all three at the moment. Clearly, money is too tight. There's plenty of evidence for that. That's what the yield curve is telling us. And lots of other liquidity and monetary type models have that message as well. And then, let's not forget, money supply is now shrinking. If you look at M2, contracting on an annualized basis, it hasn't done that for 100 years. And whenever it did that in the last couple of 100 years, it would always cause a phase of outright deflation or a banking crisis, or a recession or a depression. So it always causes some sort of major problem in the economy. And so money supply is contracting. And of course, the reason it's contracting is because deposits are leaving the banking system. They're making their way into money market funds and high yielding assets, sovereign bonds, things like that. And so that's driving this big contraction in money supply. Whenever money supply in real terms shrinks, it's a recession. And it's all happening at a time when credit conditions are already super tight. So, whenever you get tight credit conditions, generally you see a recession, and those credit conditions tell you that we should see probably quite a significant contraction in bank lending in the US economy. We'd expect something in the region of 10, 15, 20% in overall bank loans in terms of the size of the contraction. So, look, I think all of this tells you want to be owning bonds. When the cyclical parts of the economy weaken, bond yields fall. A great way of thinking about that is the US inventory cycle. Inventories and bonds are highly correlated. And as well as all of that, you've got inflation that is starting to weaken. I mean, I think the inflation number we had last week was fascinating. If you look at services inflation, ex shelter, and let's not forget, services is really domestically generated inflationary pressure. It's the type of inflation the Fed is willing and able to control. That number, ex shelter, was negative month on month. We've had a handful of pretty tame readings on services. And with that, wage inflation is softening quite significantly. So I think you want to own bonds for recession, and because of the shock in the economy and tight money and signs that companies are retrenching and drawing inventories, but also because inflation's topping out and falling. The leading indicators, by the way, suggest inflation should keep moving lower. And then as well as all of that, you've got a market that is very short bonds in terms of net speculative futures positioning. The shorts are pretty big. So it's a crowded short trade. There's a lot of bearishness, and it all tells you that we've got plenty of fuel for a rally in bonds over the course of the next 6, 9, 12 months or so. So that, I think, is a compelling asset allocation recommendation given that macro and inflation setup.
That's highly interesting, Harry. Looking forward to keep track of this quite gloomy or dark outlook for at least for equities, but less so for bonds, obviously. Yeah. Thanks, Harry.
Brilliant. Thanks, Stefan. Thanks a lot.